India is getting more prosperous, per capita incomes are rising, you are seeing a higher allocation coming into household savings financially and within financial savings in the equity market. So that is certainly true that a larger part of Indian household savings are coming to the market. Structurally, this trend should continue. LIC invests 1 lakh crores or 2 lakh crores every year in the market, and that number, along with mutual fund SIPs, private insurance companies, EPFO, has become 2-3x that size. But again, all these are factors that are variable. So one should not get sucked in by the narrative that because insurance money will always come into the market, mutual fund SIPs will come in, market will only go in one direction.
In the last 6 months, the Indian stock market capitalization has gone up from $4 trillion to $5 trillion. Annually, approximately more than $40 billion of new fund flows are coming into the equity markets via SIPs, pension fund contributions, insurance contributions and the like. A lot has been spoken about the demand side of Indian equity markets and how there is a lot of inflow happening into this market. The side of the market that is not so much spoken about is the supply side, which is where is the new equity infusion coming from and is there more supply coming into the market. Today, we discuss this topic, which is what's happening to supply side of the equity market and what does that indicate in terms of future onboardings for the overall equity investing segment. Joining me for this episode today is Ashish Gupta. Ashish, welcome.
Thanks.
Ashish is the Chief Investment Officer of Axis Mutual Fund. He has more than 2 decades of experience in the equity research and investing space. He's a very well-known personality in this space. Ashish, thanks for joining us.
My pleasure.
So Ashish, to start with, there is this Adam Smith theory, right, that demand and supply always match. And we've seen over, I think post-COVID, there is this story of more and more equity flows coming into the market. Prices going up thanks to kind of supply coming in. And we've also seen that when global markets have fallen, Indian markets haven't fallen that much.
Absolutely.
Because new supply just always keeps coming in. So is this a fairy tale or do you see somewhere this balance kind of coming back?
So I think first of all, in any market and particularly equity markets, one has to realize that at any point of time, demand and supply is in balance most of the time, right? Because when a trade is happening, when someone is buying, someone is selling, right? So there are always the same number of buyers and same number of sellers. Of course, there are points in time where once in 10 years you will have the market at a circuit. That means that there are either more sellers or more buyers. But on a day-to-day functioning basis, always demand and supply is balanced, right? The narrative, however, has been that there are various types of demand. Some demand is sentiment-driven, some demand is uncertain, some demand is systematic, right? And that has been a very strong narrative in India for the last 3-4 years, as you mentioned, after COVID, because household savings went up and a lot of domestic savings started coming to the market. It is a fact that in India, of the total household saving, financial savings was a small percentage. That has gone up. It's now about 50% of total household savings. And within financial savings, equity was a small allocation. As India is getting more prosperous, per capita incomes are rising, you are seeing a higher allocation coming into household savings financially and within financial savings in the equity market. So that is certainly true that a larger part of Indian household savings are coming to the market, and structurally this trend should continue. But always there are cycles in this, right? So no structural trend is only one way. The other narrative is that in this demand, because people have subscribed to SIPs or money is coming from their pension fund, certain amount of money will always come to the market, which is certainly true. And you mentioned the number about $40 billion, 3.5 lakh crores is the current amount of money that comes into the market. But there are other players. So market has several players. So there is domestic retail investors, there is domestic institutional investors, there are international investors, there are hedge funds that play the market. So market is made up of various type of constituents who kind of trade in and trade out. And what we wanted to talk about was the fact that yes, there is this amount which probably a few years ago was about $10-15 billion, which has become $40 billion. So the money that you can really say for sure will come into the market each year, if that was $10-15 billion a few years ago, is now $40 billion. So like LIC invests 1 lakh crore or 2 lakh crores every year in the market, and that number along with mutual fund SIPs, private insurance companies, EPFO has become now 2-3x that size. But as you rightly said, in economics, as demand comes, so does supply.
Right.
The supply increases, particularly when price goes up. Right. So here we can talk about price as the price of a stock or index, or more importantly, the multiples.
Right.
So it's common knowledge that market multiples have moved up. Last 10-year average of market multiple is about 16 times. Today it is at about 21 times for the broad index, whether you speak of Nifty or Sensex. If you look at the mid and small cap indices, multiples are even more elevated. They are at about 28 times. So the multiples in the market have moved up quite significantly. And that's the economic theory, that as price moves up, new kind of sellers also emerge, right? And that's what we are seeing today, that there is supply that is coming in, and just in the last month, secondary stake sales by promoters, PE, etc., was almost 60,000 crores.
Right.
And actually, we did these numbers that over the last 15 months, the total supply that has come in is actually much more than whatever is the mutual fund inflows.
Right.
Of course, the market has still gone up because over this period, foreign investors but also buyers, domestic retail, in addition to putting money into insurance companies, mutual funds, but also buying directly into equities. But again, all these are factors that are variable.
Right.
So one should not get sucked in by the narrative that because insurance money will always come into the market, mutual fund SIPs will come in, the market will only go in one direction.
So Ashish, let's take this and kind of deep dive a little bit into it, right? So first is just for clarity, in investing, and there is always a buyer and a seller.
Yes.
So there is a market right now which is, let's say if there is company X has certain percentage which is held by the public, right? So let's say that is 30%.
Yes.
So if their total market cap is 100 rupees, 30 rupees of shares are available, and those are being traded.
Yes.
Now, new supply, I'm just paraphrasing, so please correct me if I'm wrong.
Sure.
New supply is that either the promoter says, now instead of 30, let me sell 10 more.
Sure.
And so that 10 also comes into the market.
Yes.
Or a new company comes in and says, in addition to this 100, I am also bringing in,
Yes.
on my own 100.
Yes.
So now instead of the pool being 30, it has become 60 because 30% of that is also.
Yes.
So this is the notion of new supply and new sellers coming into the market.
So I think if we can look at it, supply, it can come from three ways, right? So as you said, there is certain free float of the company, which is let's say 30%. In the example you quoted, 70% is held by the promoter, and promoter brings down his holding by selling say 5%, 10%, right? So the free float increases. The other way could be that the company itself raises capital.
Right.
So promoter does not sell but dilutes himself.
Right.
So the capital base expands. So so the 30% is on a wider base.
Right.
Right. Or the other third way could be that there's a new company that comes in and it also floats its equity.
Right. And Ashish, just before we go further, this capital raise,
Yes.
it can also be like there can be capital raise wherein the company is raising capital and using it for investments and further, whatever, increasing its market share and so on and so forth.
Yes.
Or there could be just the promoter selling or somebody else selling, in which case the capital, it is not going into growth, it is going into the promoter's pockets or somebody else's pockets.
Yes.
So there are two types also of usage of...
and that's an important distinction because there are two messages that come to you, right? So, for example, if you're investing in a company or if you're giving money to a company, the company invests in its business, that means potentially the growth is going to be faster, right? So you feel more comfortable, it's an easier decision for you to make that I'm giving money to this, the company will grow faster in the future than it has been growing till now, and therefore I will get better return on capital. The second aspect of this is also that what is the signaling, right? Because I'm an outsider, and I have a certain view on the company, the market has certain view on the company, and someone who's sitting on the board of the company, say who's a private equity investor, or the company promoter himself is saying that, okay, if this is a good price to sell, that's a very strong signal.
Yeah, that guy knows something that probably you don't.
Yes.
Right. Understood. So now let's using this, let's look at what's happening to the market. So if you can just help us understand what are different types of pools of supply that is coming in.
Sure.
And subsequently, next question will go into where is it going?
Sure.
Also, yeah.
So one of the sources of supply has been IPOs, so new companies getting listed.
Yeah.
Last year, about 75 companies got listed, new companies got listed. They approximately raised about 55,000 crores of rupees.
Right.
It was a number not too different from the previous year. So FY23, 24 were similar numbers.
Right.
But in the first quarter, we have seen a big jump. And actually today, as we sit, and I'm sure if you open the newspaper, you'll see the number of IPO ads in the pink papers probably occupy about 30% of the ad space. Right? So that number is going to go up significantly. In fact, in the July to September quarter, the amount of IPOs being raised is 3 times what was raised in the April to June quarter. So, so these are the initial public offering or new company listing. In addition, we are seeing stake sales. So we call the first one primary raise, where new shares are being issued. And the second one is secondary stake sales, where someone who already has shares is selling it. And we are seeing a lot of these secondary stake sales coming, even from promoters of the companies. And actually, over the past year, interestingly, we have seen stake sale not just by Indian promoters, but even multinational companies who have their Indian subsidiaries finding the valuation attractive enough and selling part of their stakes in their Indian subsidiaries. The third and a very large component is also private equity selling stakes. And again, private equity capital is growth capital. So they have invested in these companies over the past few years, and like any asset manager, they have a finite life to their fund. So they always need to continue to churn their capital. So both because of the time they have had their investments, as well as the return they are making on these, they are finding it an opportune time to kind of come and sell. So basically, we are seeing promoters selling, we are seeing PE selling, and we are seeing IPOs.
Right. So from all elements of supply, we are seeing more supply come in.
Yes.
Moving on, like where is the capital being raised? Where is it going?
Again, if we look at the private equity selling, actually most of these funds then have to be repatriated back.
Right.
So if you see FDI outflow from India, that has gone up materially. So in 2024, it was nearly 60% higher than amount of FDI that was repatriated in FY23, and FY25. Given the trend, it's going to be an even larger number.
Right.
Right. If we look at the promoter selling, we unfortunately don't have the data where that funds are being recycled. So potentially they're being recycled into the broader savings pool. Some part of it may be coming into the broader market. So maybe he's selling a stake in his company and is buying a diversified portfolio, or he may be making other investments. So we don't have that data. The third part is IPOs, and there before the IPO, disclosures have to be made about usage of funds. And again, if we see in the IPOs, nearly 60% of the IPO money is also not primary capital.
Right.
So the company is getting listed, but 60% of that is offer from sale from the promoter or private equity who's actually selling their stake.
Right.
So of the total money being raised from IPO, only 40% is going into the company. The balance 60% is actually again a form of secondary stake sale. And of that, only a small part, so only about 15% is really growth capital. So which is going for either capex or a bank raising more equity to give loans. Bulk of it is now for working capital or general purposes, right? So, so there is not a very definitive growth capital component even in the IPOs.
So just to summarize this, three pools of supply: promoters, private equity, and primary issuances.
Yes.
Promoter and private equity is almost entirely money not going to the company; it's going into
Yes.
these are investment returns.
Yes.
Some investor who invested is now kind of selling and
Yes.
taking that money. They may do whatever with it, but it
Yes.
is definitely not going into further growth of the company.
Yes.
The third pool also 60% actually is again investors selling.
Yes.
40% is going to the company. Of that 40%, 15% is actually growth, and the rest is maybe
Yes.
they are deleveraging or
Yes.
something of that nature. So net about 6% is actually growth capital. The rest is basically someone, either a investor or the promoter himself,
Yes.
basically saying that the price is very attractive.
Yes.
So let me sell my share in the company
Yes.
and take that price.
Yes.
And this individual is far more intelligent than you and I. In a sense, they know their company far more than you and I.
And more importantly, they have seen multiple cycles.
Yep.
They have a long-term view,
Yep.
right? So we need to be more cognizant of the fact that maybe the cycle is good now, but they know no cycle lasts forever.
Forever. Yeah. Yeah. So in some ways, it is signaling that this is the time to sell. I mean, kind of
Sure.
making a very simplistic statement.
Sure.
But their view is that this is the best time to sell, so they are not holding it for a year more, 2 years more. They are selling it now. Now this also, Ashish, like you mentioned, like let's say hypothetically there is some global conglomerate.
Yes.
Now we've seen some global conglomerates actually. So the earlier model of growth was that there is a global conglomerate. They will infuse capital into India from, let's say, Hong Kong or London
Yes.
or wherever, right?
Yes.
And the Indian company is the growth engine because
Yes.
growth is faster in India, and so you put capital in so that you grow.
Yes.
We are now seeing that actually this conglomerate is saying, actually, let me sell the Indian capital, take it out,
Yes.
and maybe use it somewhere else.
Yes.
So how do you read this? Like, what's happening here?
So I think it's really a reflection of what is happening to the cost of capital.
Right.
So globally, in the last 4 years, cost of capital has gone up because interest rates went up. So where the MNC parent is leverage, right? He is finding it, the Indian subsidiary, a good place to raise money to deleverage it, right? Because the cost of capital is very high. For some of the companies globally listed, and we have seen, or we are seeing one Korean company coming for an IPO, their cost of equity is also very high.
Right.
Because for whatever reason, in that market, that company trades at a single digit P.
Right.
The whole market trades at a single digit P, so does this company, right? And they find that in India, the company is being valued at 4-5x what the parent trades in.
Right.
So they find it very attractive from a capital allocation perspective that
sell in India and
yes, and potentially if they want, they can use
buy
that
back,
money to buy back or whatever. So I think at the end of the day, that is why valuation matter, because money is fungible. Right. So I think while not necessarily Indian investor or the Indian retail guy may not be buying a Korean stock or a Japanese stock, but money is fungible. So as valuation differentials widen, there will be people trying to take advantage of this arbitrage.
Right. Now, if we kind of take a big step back, Ashish, and go back to our textbooks. Basically, the purpose of capital markets was to allocate capital so that kind of you put it into the most efficient users. And the reason why equity investing, etc., is so celebrated because it's money coming into, let's say, slightly riskier ventures.
Yes.
But then it kind of creates more productive assets, propels growth, and the overall economy kind of benefits. In a situation where 94% of the money is not going into productive assets. So what does that mean for the the performance of the overall investing space?
See, if we look from a macro basis, irrespective of whether the money is directly coming into the capital of the company or it is being raised by the promoter, if he is investing privately, etc., on a macro basis, it makes no difference, right? On a macro basis, it will make a difference only if he uses the money to buy a mansion in UK, right? So then there's a balance of payment outflow. Otherwise, it's just money circulating within the country, right? So on a macro basis, it does not. I think what we are also potentially going to see a trend is that people use these valuations to do more M&A, right? And we are seeing some announcements of that now because, yes, valuations are high, so people can either raise money or use the fact that their company is valued attractively to buy other companies either domestically or internationally, right? So that's another potentially value creative way. But it's not necessarily that, and again, even on private equity, you can have, if private equity makes good returns in India and they have good track record of having exits and returning money, more private equity
capital will come in.
Will come in, right? So I'm not worried on that account that money not just is getting unproductive. In fact, I've always believed whether it is FII flow or FDI flow, money coming in is good
for the economy. Yeah.
Yes.
So basically what you're saying is that this is temporal right now because it's very attractive, supply is increasing.
Yes.
Even if supply is increasing, all the people who are taking the money out will at some point come back because frankly, private equity has to continue to invest and the promoter also ideally maybe he'll buy one mansion, but the rest of it kind of will come back into some investment kind of a thing. So at this point, what's happening is maybe there's a balancing that's happening, which is that because the multiples have gone up, the supply side is now finding it attractive to
step up,
bring in more supply, so that the demand can be met.
And that's the beauty of a free market, right? So market is a self-correcting or self-balancing mechanism.
Right.
So when demand went up, you have now supply going up, and it will kind of balance it out, and it will again establish an equilibrium.
Right. And so, Ashish, in terms of, like, if you look at, let's say, the next 6 to 12 months, what is the visibility on supply coming into the market? What kind of numbers are you seeing versus demand?
Yeah, so I think we don't have perfect numbers for this, because a lot of these, as we talked about, are secondary stake sales, and people can take that decision uh, um, very intuitively. But if we look at the pipeline of IPOs, so that is now nearly 1 lakh crores. Another way to look at potential supply is look at what is the private equity stakes in already listed companies, and where the investment was made more than 3 years ago.
Right.
So that number is another 2 lakh crore plus. Right. Then the third piece is what is the private equity stakes in private companies, so companies that have not listed yet, but again that were made at least 3 years ago. So if you add all these up, that alone gives you a number of more than 5 lakh crores. Right?
5 lakh crores of the next.
Yeah, so we don't know the time whether it comes over the next 12
Sure.
months or 18 months.
But in that range, basically.
In that range. And again, if we look at the last 15 months, from these sources, plus the promoter stake sales, we had about 4 lakh crores coming in.
Right.
And we are saying more than 5 lakh crores just coming from private equity and filed IPOs. And again, as we have seen in the last few months, promoters are also finding this an attractive level to raise money.
Right. And compared to that, what is the inflow?
So inflow, as we said, lot depends on the sentiment, right?
Right.
So last year, domestic retail directly invested $24 billion into the market, direct purchase of equity, right? In addition, the mutual fund inflow last year was about 3 lakh crores.
Right.
Net inflow, right? And last year, FIIs were buyer of about $15 billion or so, right? So more than 1 lakh crores,
Right.
Now, historically, we have seen volatility around based on how the discretionary flows, so direct money into retail, direct retail money into the market, FII flows. So they can be positive for a few months, they can be negative for a few months. So the point is that given that now supply overwhelms what is the steady money coming into the market through SIP and insurance, the direction of the market will be determined by how these volatile pieces
Right.
of inflows or
Right.
Demand trend.
Right.
Outlook for that is not negative as
Right.
of now.
Of course.
FIIs, if anything, are underweight on India still, because they have not invested much in the last 4 years. And potentially, if US rates are going to be cut down aggressively, then you can build a case that more
will come.
More will come, right? And if that happens, then all this demand can be easily met. But just the SIP and insurance flows alone will not be able to kind of determine the market direction.
Understood. And so, Ashish, now as a retail investor, what does all of this mean, and how what should people take away from this?
So I think for the retail investors, 2 things. One is that don't fall prey to narratives, right? You will always have some narratives around the market or around particular sectors. I think the markets in India are very broad-based.
Right.
There are multiple types of players that are always active. And as we talked about the fact that even in last quarter, there was so much promoter selling, but the market still went up.
Right.
So no one participant determines the direction of the market.
Right.
And therefore, for retail investors, it is very important that when you look at these markets, and particularly at these multiples, do invest only for the long term, right?
Right.
It's very difficult to call direction of the market in for the next 3 months or 6 months, particularly at these multiples, because the multiples are higher than where they have historically been. So the probability that you will make as much return in the next 6 months as you made in the last 6 months is lower, right? Because your multiple has moved higher. So you come into the market with a view that you are here for the multi-year horizon, not just because the narrative is that this month SIP flows went up from 22,000 crores to 23,000 crores.
Thanks, Ashish. Very interesting conversation. Just to summarize this, kind of a lot has been spoken about the equity culture in India and how retail is participating, and that's kind of creating a baseline effect. Not so much has been spoken about the supply side. What you pointed out to us is that as this demand and inflow has increased, the supply has also increased now. And the supply has increased because multiples have gotten to a point where, owners of equity are seeing great value in bringing in more supply into the market. And as you said, the market is a self-correcting mechanism. When demand goes up, supply also goes up and finds the level playing field.
Yes.
We spoke about 3 types of supply. We spoke about private equity, promoters, and IPOs, which is new equity coming into the market. We've seen on all 3 an increase in supply. So private equity is selling, promoters are selling, and new IPOs are coming in. And you estimate that over the next 12, 18 months, about 5 lakh crores of new supply will come and hit the market. 6% of this is growth capital. The rest of it is basically investment returns for people.
Yes.
Which means that the capital is not necessarily being deployed into productive growth at this point in time. It is likely being recycled. It's going from one investor to another, which is not bad in itself, because that investor will come back and will kind of invest that money somewhere else. So nothing wrong. But if you are today buying equity, you should know that you are not not everything that you are doing is going to the growth of the company. Yes. A lot of it is going towards investment returns. Which is, again, we discussed that it's fine, not an issue. So from a retail investor's perspective, focus on valuations, focus on long term. Don't be driven by narratives, and if you do that, you'll kind of be safe over the longer term.
Perfect.
Thank you. Thanks a lot, Ashish, for your time, and it was a very interesting conversation.
Thanks, sir.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.